Cisco's doing shit. I ended up selling my EA stock. I got rid of it. I took a loss.
I guess it went up after that.
No, it didn't. It didn't, which is good because it means I'm not stupid. And overall, I've already recovered from my loss.
Not a lot of the big video game companies are getting flagged now because they're trying to make everything mobile and free to play.
Yeah. Well, my Activision stock is doing better. They've been doing all right.
Activision hasn't taken much flag, that's why.
They're all right. Anyway, hello everybody. This is the Thymble podcast. I'm Ben.
I'm Tyler.
And this is episode 5 of the podcast. And so far we've talked about a lot of good subjects like bonds, stocks, talked about general investing advice, talked about some diversification and some general principles about that. Today we're going to focus on some more miscellaneous investment vehicles, just to kind of add some variety to your portfolio.
Mm-hmm.
And so I think,
things up a bit.
yeah, it's good. I mean, we already talked about diversification, and so this is, another way to diversify, is including some of these different
alternative investments. Yeah.
Exactly. So we can start with whatever. We can start with REITs.
Sounds good.
That's pretty.
Okay.
Oh, you wanted to do less risky.
I guess we can start with safe. Like, this isn't an alternative investment. Like, the safer ones, like CDs, though.
Yeah.
Money markets, that sort.
Let's do that then. CDs. What's a CD?
CD is essentially.
It's not disc, right?
No. CD essentially you put a lump sum aside and get X amount back via interest rate. So CDs will typically pay more than a savings where you're getting what are you getting at this point? 0.5% maybe for lucky.
Nothing. Yeah, basically.
Yeah, nothing.
Yeah.
And CDs, maybe in the interest rate market that we're currently facing, 2 to 3%. Historically, they were much higher than that, but at this point, you're lucky if you find those. Maybe if you do jumbo CDs, which larger lump sum amounts like $10,000, $100,000, that sort, you can even see higher interest rates than that, but not too much. So, nonetheless, it's an easier and safer means because you're investing directly with the bank. They're taking that.
Yeah.
Whatnot, turning around in 3 months, 6 months, 9 months, 12 months.
Yeah. So unless the bank fails,
yeah,
you're pretty good.
Exactly.
You have to keep it in for a certain amount of time. It's a time deposit, right? Mm-hmm. So, but there's varying maturities, right?
Yeah, and that's one technique that a lot of investors use is laddering these CDs. Mm-hmm. And so, like we were saying, maybe you'll have a few 6 months, so you have that short-term liquidity and can take your money out if need be. Yeah. And then you match that maybe with a year and a half, 2 year CD.
Sure. Isn't there 2 weeks? Isn't there as short as
There's very short ones. I don't know about 2 weeks. I'd have to see that. I think 1 month might be the shortest to my knowledge. But nonetheless, early liquidation is the biggest thing. You don't want to early liquidate these because you're going to have a fee involved in that. So that's why you might want to look at this laddering strategy.
So you got to commit.
Yes.
You got to make sure that that's not money that you're going to need to buy bread.
Mm-hmm. But nonetheless, it's not too hefty, so you can still take them.
I'm a little disappointed that CDs aren't like old records that you can sell and make money on.
That could be another investment strategy we talk about along with artwork like we were talking later.
Yeah.
We'll leave that.
That was a bad joke, but I don't know.
We'll cut that for the sake of our viewers.
Yeah. So that's a really safe one. Mm-hmm. Now we'll talk about REITs.
Oh, you don't want to do money markets?
Oh, money markets.
Money markets is a glorified savings account that literally gets 1%. Okay, next.
There we go. That's really how much.
Now time for REITs. Okay, so real estate investment trust, essentially a large holding company owns a number of properties and rents these out to, say, commercial developers, to hospitals, to food chains, even things like salons, malls, whatnot. It's all whatever you're looking for, I guess, investment-wise. So they're collecting the least money.
There's different kinds, right? There's people who there's REITs that make money on income, and then there's mortgages, right? There's at least that's one of the biggest.
Yeah. So they're collecting essentially from the tenants. Yeah. And that is what is then flipped out to the investors or us in the form of dividends.
Yes.
Mm-hmm. So go ahead.
I was just going to say, there's some advantages and disadvantages to these. So some of the advantages. Normally when you think of real estate, not a REIT, but just straight up in real estate, we might comment on that more, but. That's something that when you buy a house, you're stuck with a house, and it's not easy to sell that. Yeah. So, a REIT is something you can invest in real estate without the commitment of having to hold on to that. It's much more liquid.
Public trade directly on the stock market.
Exactly.
And you're putting, just like you would in a normal stock, $100 toward this. You get that diversification, but you also get that niche preference that you're looking for. So, like we were saying, if you want commercial development holdings, then you will get the exposure to that, but you get a number of different pieces involved.
So it's like diversified within, it's
Mm-hmm.
diversification within diversification. So
Yeah.
if you include REITs in your portfolio,
Mm-hmm.
the REITs themselves can be diversified in the fact of where they get their income,
Mm-hmm.
you know, where they're getting the money from.
Yeah.
And but again, and it's more liquidable, so it's you know, you can buy and sell,
There you go.
and it's not, you're not stuck with it.
Mm-hmm.
You know, if it, because real estate, I mean, is big.
Yes.
I mean, you can make a lot of money on real estate,
But you can also lose that same
a
lot of money, so it's that risk return.
Exactly,
Mhm.
and so in that way, it's hedging that risk as well.
Yeah.
It's really mitigating a lot of that risk by making it more liquidable.
And especially if you like have a preference for maybe like you want to see a one niche or place region in the U.S. or some other country is doing, or how a specific number of companies are doing, maybe just invest in one of these to see how that local climate is before you go in yourself, whether it's not you want to build a property, whether or not
Oh yeah,
you
sure.
want to live there.
It's
or
like testing
what
the waters.
Yeah.
Yeah, that's actually a really good idea.
Mhm.
Yeah. What else? Anything else about
Like,
REITs?
Not
That's
REIT
about it.
specifically, no.
Not REITs specifically.
Not
What?
REIT specifically.
All right. What's the next thing?
What you want to dive into? What kind of email? You want to dive into the
No
Oh.
emails allowed.
Wait, hold on, let me check it.
What is it important?
You want to dive? Oh yeah, hold on, yeah.
What?
No,
Joseph? What is Joseph?
What? Derivatives. We were talking about
Yeah,
previous. We
derivatives.
talked about the options that you could, gauge and essentially hedge against where stock's going to move.
Yeah.
We talked about shorting and longing those.
Yep.
You can also do derivative-wise. There's things like foreign exchange derivatives. So if you're betting that the euro is going to go up against the dollar, then maybe you'll hedge one way. Especially if you have euros, you have dollars, and you have that foreign exchange risk already under your belt. Or you could just straight up try to bet on it and see how that goes.
Yeah.
But that's a more risky play.
Mm-hmm.
And similar to that is the interest rate risk. So
Yeah.
if you have a fixed rate and you want to trade for a variable rate, you could swap that between companies, or you could swap that between individuals, what have you.
Yeah. And so this is getting some more in-depth.
This is getting some in-depth stuff.
That's more in-depth stuff, but the gist of the derivative.
The gist of derivatives are that a lot of people use them for betting, but the majority is used for hedging sake, and you want to ensure that it is more or less for safety's sake. Unless you're really confident, you're really looking to take on big risk, big reward, that sort, then I would not advise, unless you already have that exposure like we were talking about. You have large sums of euros, you have a $500,000 term loan out there with a fixed interest rate. That sort is where you'd want to start to see these derivatives.
Yeah, I mean, you're buying, just to kind of remind, just to make sure it's nailed home, the derivative is you're basically buying someone else's risk, I guess, right?
Yes.
I mean, that's a good
You're
way
buying and selling risk.
Yeah, and so that's just keep that in mind. That's just
It's deriving off an underlying asset.
Yes.
So it's deriving off a stock, deriving
Yes.
off a bond or foreign exchange or commodities. Even
Yeah.
when we're seeing, I want to lock the rate in for maybe like indigo or as a farmer maybe for corn, because knowing I might be able to get X amount for a bundle now and that might go down the future, I'll lock in this bundle now to sell it now.
I mean, I don't know if I'm mistaken, but I think I've read that a lot of times banks, when they sell derivatives, I mean, they kind of use them as insurance in a way. Like it insures their loans.
It can be insured for a number of different people involved. Yeah, it's all.
I mean, even the derivative itself isn't it kind of a form of insurance for the? I mean,
it is, yeah.
Maybe not the technical, like absolute, like the legit insurance, because of course you can insure investments and things.
But that's what they nickname you,
Sure.
Yeah.
Yeah. Cool. Right, yeah, and so there's a lot of depth and strategy you can go into when it comes to derivatives, and they're relatively newer. I think out of a lot of investment vehicles, those are some of the newer ones.
And that's what when you hear, and especially this is the reason you don't want to do it just for the sake of betting, is that's what caused the 2008 financial crisis. You hear, collateralized debt obligations, which is essentially repackaging, reselling debt to the point that nobody even knows who owns what debt. It's so risky, it's so blown out of proportion. And then when everyone defaults on those properties, those homes out there, a lot of the investors took the brunt of that on top of those that own the properties.
And if you want to know more about that, I'm going to endorse
watch a future season in which we're going to talk about
that's
history
true.
And the crisis and
or
the history of the general bank.
I'm going to recommend the movie The Big Short.
Well, that too.
It's a good movie. It's got a good explanation of the crisis and things like that. And so,
but definitely for future videos, we would like to touch on like financial crises in the past. We would like to touch on things such as the Great Depression, things such as how money came to be and all that sort.
Yeah, the most interesting stuff.
All the most interesting stuff.
Now we can make it interesting. It'll be interesting. But okay, so we talked about derivatives. Let's we got to talk about commodities.
Commodities, yes.
Yeah, so we got to talk about commodities. So commodities, I mean, it comes down to
again. That would probably have gone best, right before the CDs and money markets that we're talking about. But essentially, it's just a much safer means of buying directly into something like we were talking about crops like indigo, corn, cotton, or you could go into metals like copper or like we're seeing right now with the silicon is a huge one for.
Did you say oil? Did you bring up oil? I mean oil.
Oil's a huge one. Oil and gas, energies. That's a whole market of its own.
Gold is considered a commodity.
Yeah, and so when we're seeing a lot of metals are usually safer unless they're things like silicon and lithium where they're suddenly taking off and being used in a lot more electronics.
Yeah.
But things like the energy markets may be a lot more volatile. So if you're looking for that safer spectrum, you want to house it in like gold because you probably want to go back to that.
Yeah. Don't put all of your money in gold.
No.
Because that's dumb.
Yes.
but
even gold has its fluctuations.
No, it does. It does. I mean, it's just I think sometimes people you hear a lot of
it's a safe haven when really
if everything goes to shit, I have my gold.
Yeah.
I don't know. I think if everything goes to shit, you might want water, food, not gold.
What are you checking over there?
Don't talk to the cameraman. Don't talk to him.
We don't even have a cameraman. It's just two cameras sitting there.
I'm the cameraman.
Yeah, okay. Thanks for joining us today.
I control the cameras with my mind. Every time there's a cut, that's me doing. That's not editing. That's me turning off and on the cameras.
When you blink real hard.
Anyway.
See, he is laughing. Now you know there's a cameraman.
Now you know.
Way to go.
I mean,
shoot, that's cut.
Shoot.
That's a cut. Then you have your other end of the spectrum, like we were saying, oil. So then you're suddenly getting into this goes back to our very first episode of due diligence.
Yeah.
You're going into OPEC and whether or not they're going to raise prices or keep a flat rate on that, or whether or not you're going to be able to tap into more of what's going on in Russia and the drilling over there, or whether or not we can tap domestically or in Canada.
Think about our own. You think our own drilling here.
And so suddenly you have all these variables and. There's even new, really interesting technology coming out where they use satellites to monitor those big oil barrels and basins out there to see where the level is within inside them to tell whether or not OPEC's actually, capable of producing more oil than it is.
And good, because I don't trust OPEC. I don't trust them.
Oh, cameraman doesn't know where this one's going.
No, I'm just saying I don't trust them. I mean,
No, essentially
it's a big cartel.
It's a monopolized hold on the oil industry.
Yeah.
So that's why technology like this helps us to become more transparent on commodities, to know what the true rate is going to be going
So I don't feel bad for spying on them. That's what that is spying on them with satellites, looking at their oil wells.
Might want to cut that part.
Why?
I don't know if I'd say cartel nor spying.
They are the definition of a cartel.
Monopolized industry.
What are you running for president?
Trying to make this a successful podcast, Ben. Really trying here.
Who's gonna disagree? You're just arguing semantics.
I said monopolized industry. I never said what you said. Cartel.
That's what I'm saying. You're just talking about words, but you know what I mean, and I know what you mean.
Yeah, and you know I'm right.
No.
Continuing on, what else do we have? Anything other than commodities?
What?
Do we want to talk about artwork and more expensive, higher end investments?
Did you talk about futures yet?
Yeah, futures are essentially covered in derivatives. That is without saying it, we said it because interest rate locking in.
You're not going to mention the term though.
We don't have to. When we literally just covered it, and I can't suddenly say futures now, and then you edit that in. That'd be stupid. Futures. What? Suddenly, much louder volume. All right, we're going to talk about option futures, and we're going to talk about crops. So we wanted to talk about more expensive investments out there. And again, this is all how knowledgeable are you on these pieces, these assets?
Yeah.
If you're looking at artwork as a means of investment for the future, you really have to know your artist. You really have to know what's considered art and the concept of that going forward. You have to understand the different markets and niches for that.
Sure.
I mean, artwork could be valuable then, and suddenly in the future it's mass produced and it's no longer worth what you thought, or vice versa.
It's like Beanie Babies.
Yeah, or you could have some today that's worth nothing, but you have. I missed that. It's that vintage value, like down the road, suddenly this is actually something valuable. Well, I wouldn't bank on this, and this is again, it's all your own preference for that sort of stuff.
Yeah.
But nonetheless, it's an asset vehicle out there.
Sure. Yeah. I mean, you gotta be in tune with the baloney that is artwork.
Mm-hmm.
I mean, I
here we go for his special opinion.
I'm allowed to have
opinionated.
opinions.
I didn't say you worry. I'm just saying, you're very vocal in your opinions.
I'm just, you want me to whisper it?
Yeah, could you?
Artwork is baloney. There you go. I like art.
Futures.
But yeah, I mean, no, it's definitely viable. It's just, you gotta already have a lot of capital in the first place.
Yeah.
And I don't think a lot of our audience is gonna have that much capital.
Yeah, I mean, that's a much,
Yeah.
later on, once you have time to mature your current investments, I would maybe look at some artwork, especially if you want it for your own sake.
Yeah.
And then also, another quick one to touch on is private placements. So again, these are usually much, much bigger, and you have to be close to companies or...
You gotta have an in. I mean, you gotta, you basically, most of the time it's companies coming to you.
Yes, especially if you have your own company in that sense, a private equity is gonna come to you and say, can we take a part in this? Can we have some management oversight in return for X amount of return from the company, but you'll also get a portion of that, etc. So they're investing, essentially what would be stock if it was public, but this is all private, so no one else in the general vicinity, unless you know them or close to them, will have access to it.
It's not an open exchange.
Yeah, and the same is the case with private debt placements. If you want to go ahead and say give somebody a private loan that's not with a bank or with anything else, you just want to lend them money, they say they'll give you X back, you sign a contract, and that's it. But again, these are much higher dollar values, at least $1 million plus. I mean, for the most part, unless it's a small. Let's say you maybe have a bakery or something, and it's just within the family. Maybe you're lending $100,000 or something like that.
Yeah, I mean that's definitely.
But within the family, you're probably not looking to make interest rates off your own family.
Wow.
Maybe if you're Ben.
Yeah, if you're with my kids, I'd expect returns on my investments.
We talking about the kids, or we talking about the private placements with the kids?
Both.
Yes. Answer that is yes.
I mean, but I don't know, like.
I must say, I like this new setup a lot.
The kitchen?
Yeah, it's nice. And it's easy to set up, except for our cameraman.
You belong in the kitchen, Time.
Appreciate it.
It's a changing world, and you belong in the kitchen.
Thank you.
Do you guys know what Techstars and Sequoia is?
I guess on the small private level, there's Kickstarter and stuff like that.
Yeah.
Where you can invest in things, but again, you're not really going to see return. You're just going to get the
returns,
product.
Maybe a T-shirt.
You might get a materialization of the product once it's made, if it's made. But I mean, again,
that's
the best you'll get at the small level.
Yeah, that's true. That's true. Don't invest in a restaurant. Can I just throw that out there? Restaurants are bad investments. I love food, but
I love food too. That's why I was.
But restaurants. I feel like a lot of people buy restaurants, or they hand out loans and like to support a restaurant. Like I've been watching a lot of reruns of restaurant failing shows. Where they try and save the restaurant.
Why don't you watch some other restaurant winning shows? Maybe it'll give you a more optimistic outlook for.
Maybe I'm too cynical about
your own
restaurants.
investment. Maybe you should invest in.
Well, all these people. It's weird. It's crazy. All these people buy restaurants and then they've never done anything with a restaurant in their life, and so they put hundreds of thousands of dollars. They get into some of them are like a
million. It's a huge sunk cost if you don't know what you're doing.
Exactly.
You don't have a good chef.
And so, heck, I'm just saying if you're
well, that's why if I was ever looking to invest, first of all, it wouldn't be a private placement. It'd be on the public exchange. It'd be somebody like McDonald's, but maybe the next McDonald's, because they already have a hold in the entire everything.
Like if you got in on Chipotle when they first went out, you're probably,
or Wendy's, even more helpful options of what McDonald's is.
Yeah, true. True. You gotta watch out for those IPOs, which we talked about.
Mm-hmm.
But again, that's kind of moving back towards stocks, I guess.
Yep.
So, any other alternative investment vehicles? I don't know a lot about. There's a lot of apps nowadays that you can do a lot of small time investing. I mentioned them in the first episode. There's just examples. I've never used them, so I can't say how great they are. But I've had friends who've messed with them, and they've kind of done it as a fun thing, like Robinhood.
Yeah.
Robinhood is small time stocks. I think you can go
do fractions of stocks.
Yeah, exactly. You can do some small money trading in there. So.
Thanks, Rick.
And then.
Where did that come from?
And then there's Acorn, which I think Acorn. I should have done.
What is this, like a pitch? Hold up.
What is it?
You can do it with Stash, a micro investing app that lets you invest for as little as $5, and it takes less than 2 minutes to get started.
Is this a friend of yours?
We'll even give you a $5. I'm not pitching. What? Where does he get this stuff?
This is one of your influencer friends, isn't it?
Honestly, he tries to sell his own stuff on our podcast. This is why we need to just have this automated on his end. We can set the cameras up.
I'm not a corporate shill.
Shame on camera, man.
I'm not.
Honestly, he's trying to sell his own. Soon he's gonna have a line of like organic creams.
The only reason why I even bring up Robinhood and Acorn is just because I've heard of them, not because I'm not. I won't even say do it. I won't even say, but I just say there are things you can look into them, and those are.
And that is again more due diligence. Know who you're investing with or through.
Yeah, and know what they're doing with your money.
Yeah.
But yeah, I think
stash.
What is stash? I'm a swear.
I don't know.
I'm sorry.
It's so stupid that he's trying to influence us.
Stash. Manage.
Sharp ratio. Minimize your risk while maximizing your reward. Now that we're coming back from our commercial break, Ben, you had a great point.
Which point was that?
Damn it.
No, I'm kidding. We just want to reiterate that, the attitude of this podcast, what we want to try and communicate to you as an audience is that, we've talked about a lot of different investment vehicles, and we've given some brief overviews of them. These are all tools that you can use to fit your personality and to fit what you think is a good use of your money and a good investment. These are all valid strategies, and you can combine these vehicles to create your own strategy. And moving forward, we're wrapping up this season. This is going to be the season 1 finale. But moving forward, we want to come up with some videos where we're showing you some maybe some more in-depth strategies.
Talking more about when we're seeing diversification, when we're seeing hedging, that sort. We want to see how these assets play together.
And that's all. That's part of our goal. But also, again, you can make your own strategy. There's no gospel truth to how to invest your money properly. There are principles and there are realities of the way things work, but there's no here's how you do it. And so we're just giving you the tools that you can use to start your journey and get it going. And so and you'll learn on your own as you move forward. And that's huge, because ultimately no one is gonna completely hold your hand. We've made jokes about going walks on the beach together, but the reality
you have to the audience.
I have.
That's something.
That's because I'm funny.
Together.
It's because I'm the funny one.
Okay.
But we made jokes about that. But I mean, the reality is that no one's ever going to be able to hold your hand completely, and so that's part of.
Especially
part of the game.
Next season, I think what'll be a good basis is maybe we can do some even like brief examples of this.
Yeah,
show
exactly.
how it plays out, not just talking about it, but showing this and seeing how the factors are.
For sure.
Together.
I agree. So.
With that, that's the conclusion, right? Season.
Is that
season 1?
Is there something else you want us to say?
Can you explain to me why they bleep out God instead of bleeping out the swear word? You'd think they'd leave God and just bleep out the rest of it, but no, they take out the religious portion and leave the foul mouth.
Because honestly, I feel like the religious portion is what makes people mad.
Yeah, it does, but then if you don't get a word after it, it's just saying God.
No one cares about damn.
I don't know.
Damn is like an action. Like damn. I'm not going to tell people to invest in grills.
Grills.
I mean, like.
I would get a Weber because that holds its value, but that's just me.
A weapon?
Weber.
A Weber?
A katana.
I invest.
Anyway.
I buy. Invest in Yeezys.
Alright, so.
Just drop that. Invest in Yeezys. And I am totally serious.
Nice kicks, man.
I've never owned a pair of Yeezys.
Where did you get those?
No. Anyway, everybody, that's it. We're wrapping it up. We just want to say, get out there. Employ some of the tips that we've given you. Start messing around with maybe some simulations. The important thing is that you get moving on it
and you get comfortable feeling that.
Exactly. Yes. The earlier the better. There's no reason to wait. So hopefully we've helped you out. We welcome any feedback. If you guys got anything you want to say to us.
I appreciate your viewership for this full season.
For sure.
First season here, rough and tumble, but nonetheless, it's going to be fun. We're going to be coming back hard for season number 2.
Absolutely. So with that, next time we see you in season 2, we're gonna take you on a nice candlelit dinner, serve you up some sweet grub. You know, maybe go get a drink afterwards, but we'll see how dinner goes.
Maybe that's season 3. We'll see.
Thanks, everybody.
Thank you.